We hear about wealth building. We hear about real estate all the time. 90% of millionaires own real estate. But what if you're 40, concentrating on your lifestyle now and building retirement? Is real estate still a good investment? Well, only 15% of those with net worths of $3 to $5 million own real estate. So what about the other 85%? Let's shop. Welcome back to the Life Money Balance Podcast. I am your host, Dr. Preston Cherry, where we let your life lead your money, not your money lead your life. And your life and money are working concurrently to help you achieve your life's design. All right, let's chop about this real estate topic, y'all. Every time we turn around, we hear about how folks are being so successful in their wealth building journey and increasing their net worths exponentially with the ownership of real estate. And one of the most common topics or statistics that you'll hear about is this 90% of millionaires own real estate. And there's a lot to be unpacked with that statistic. There's not enough context in that statistic. It also means that most folks that own real estate in that 90%, they're talking about their primary residence and not necessarily a second home or a rental property necessarily. And particularly with talking to those folks at 40 years old and after, now there's a lot of lack of confidence in retirement preparedness for Gen X, 42 and above, going all the way up until 59. Gen X is starting to retire. All right. And with that lack of preparedness, there's a lack of fundamental belief that folks over 40, internally, they just don't believe that they're going to be ready enough to live fully during retirement. So I'm often asked with the clients that we serve and prospective clients that we serve at Concurrent Wealth Management is, well, after I handle all of my investments, say in my brokerage account, IRAs, 401ks, Roths, all of these different accounts. Well, what's next? Is there something different beyond the investment markets that I can get into? And we've had shows about alternative investments. We'll have more shows about that. And we'll even have more shows on real estate and answering that question of what's next. But here we want to really unpack the real estate question. And for those over 40, I believe that what I've seen with folks that already own real estate or even trying to get into real estate, owning real estate is somewhat of a, not necessarily a myth, but it's overdone, like we overcooked chicken. You don't necessarily have to have real estate in your portfolio in order to achieve the financial freedom number that you need. And so when you're concentrating on retirement, there's a lot of folks that are not filling up their buckets. They haven't maxed out their 401ks. They haven't maxed out to their capacity, their brokerage accounts, or taking advantage of, Roth conversions if it fits. There's a lot of buckets that really need to be filled before we start talking about real estate if you don't have them. However, real estate can be a additive in your portfolio for a couple of reasons. For instance, if you require some non-correlation, meaning not moving in the same market direction as the financial markets, where financial markets tend to move up or down, well, what are some of the other assets in your portfolio doing? Are they moving in the opposite direction? And real estate tends to sometimes not be correlated with the equity market. Sometimes, yes, a lot of the times not. So when you're trying to get some diversification in your portfolio, okay, then real estate may fit. Okay. But what we're going to do is walk through some of the pitfalls and advantages of real estate, and then hone in at the end of the show how all of this appeals to or is attractive to 40 years, or how does it apply? How does it apply to those that are 40 and above who are trying to live their lifestyles now and retire fully? Let's chop it up about point number one. A lot of folks simply do not make profit the way they want with real estate. 44% of those that own real estate right now fail to achieve a 10% return on their rental property investments. So, if you're, when you talk about historical returns in the financial markets, you're talking 8 to 12%. I mean, that's a little bit of a wide number there, but 8 to 12%. And when you're investing in the financial markets over a long period of time, even a decade, 15 years, again, we're talking to those folks that are 40 and above. All you have to do is have a high savings rate, taking your high income cash flows out of your business or your employment and applying them to a diversified portfolio in the markets. And over time, that risk comes down a little bit about having exposure straight to the investment markets because you're doing it over a long period of time. And it's simply not set it and forget it, but automating your savings rate, figuring out what that freedom number is in the future, and setting a savings rate accordingly and automating and filling your buckets across different types of accounts. All right. Now, with real estate, if you happen to own real estate from your 30s, your 20s, because you started with perhaps a starter home and you used some of those profits or that property you either used the property to invest into your next property using a technique called Section 121, where some of your gains in your first property are excluded from capital gains tax. If you're a single person, it's $250,000. If you're a married person, married household, then it's $500,000 that's excluded from tax as you invest in your next home. Oh, that's great. I mean, you've had time to live into your starter home, and then you started your next one. You turned your starter home into a rental property. Okay, that's in your 20s and 30s. That's you taking advantage of your previous property and moving into the next. That's great. Now you have some cash flow. Secondly, if you inherited some property, that's a way to get exposure to real estate property, right? Again, these are in your 20s and 30s. Also, as far as exposure to rental properties, there's a lot of other factors like what was the mortgage markets doing at those times? How are the rates? There's so many other factors when you're talking about owning real estate. And if you already have a small portfolio of real estate, maybe a multi-family home or a single family residence, then yeah, you keep those. Again, this is not advice, but at the same time, if you have those already in place, and that's the simplest entry point into real estate, and that tends to go well a little bit. Although we're going to talk about some pitfalls about even owning one property, far as rental, multifamily, or a single residence. We'll talk about that too, about the pitfalls of that, even if you had it back from your 20s or 30s. Okay. And what we see commonly with clients. Now, if you're 40 and you're wanting to say what's next, well, when you're talking about that 10% number, it's going to take a lot of hard work in order to achieve the returns that you need on real estate and in the time frame that you need them. When you're talking about you're 40 and you want to retire perhaps at 50, 55, 60, so 15 years at max, do you have enough time to devote to building a real estate portfolio? Do you have enough expertise to build a real estate portfolio? Do you have the willingness to deal with all the headaches and heartaches, perhaps, of a real estate portfolio when your concentration is living fully now and your lifestyle and funding retirement confidently later, right? This is the main question. We will run through some key points of owning real estate and help you say, I may want to do that. I may not want to. Okay. And when we got back to the profit formula, here's a couple of ways that if you have property or you want to have property, and we'll keep this at a high level of how you want to look into your portfolio as far as profit is consideration. Now, there's a couple of rules of thumbs that goes along with real estate. For example, the 1% rule, which is people are not really setting their rents accordingly when they are having, attempting to have a real estate portfolio with one or two properties. Now, if you've taken the time to really investigate, again, we're back here at this time incident here. If you've taken the time to research what it is to own property, be a landlord, and one of those areas is profit maximization, then you either know this or you may not, or the market is adjusting and you're under assigning the rent and shrinking your profit margin. And the 1% rule basically says that your monthly rent should be set at least 1% of the purchase price of the property. All right, that's just a jumping off point right there. And then there's another way of looking at it is how much percent over the mortgage payment, if you've taken financing, that you want to achieve over the mortgage payment, depending on what the market rates are going on at the time, as far as rents are concerned. Okay, so setting your rents properly can help you get the return that you're looking for, and not only return on your investment, but return on your time. Okay, because now we're going to move on to another rule of thumb, is the 50% rule, which is a lot of folks see that cash flow coming in from their rental properties, and they say, "Oh yeah, that is straight cash flow, straight cash, homie." Remember Randy Moss? But not all of that cash flow that's coming in gets assigned to profit. Folks forget, about covering overhead costs. So 50% of your rental income should be for property expenses, repairs, property tax, insurance. Now we'll talk about tax advantages of these areas here in a minute. That said, what 50% of your 50% of your income, your rental income, should go to expenses, will let you know already off top that rental income is not passive. Passive applies to tax of how cash flows are coming in. It doesn't mean passive activity that it takes in order to manage a property. Oh no, it's more than passive. You're very much involved in running your rental property portfolio. So don't get that twisted. Okay, there's nothing about passive income when you're talking about real estate. Okay. And then there's another metric as far as profitability is concerned, is cash on cash return. Okay. Meaning, how much cash did you put up front and what are you generating in your cash flow regularly? Okay. And it's just a ratio problem. For example, if you put $40,000 on a home and you are generating $4,000 annually on your cash flows, then you have a 10% cash on cash return. There's another metric that needs to be analyzed. And there's more and more. It's not the purpose of the show in order to get very granular. But the point I'm trying to make here is there's, as far as profitability is concerned, return on your investment, return on time. Are you making a proper enough return on your real estate investments in order to justify having them? All right. Because there's nothing passive about it. Okay. And when you're talking about 40 years old, what type of returns do you need, and where you need to be allocating your time? You probably need to be allocating your time and maximizing what you are doing currently, whether you be a business owner or a business professional, so you can generate enough income to satisfy your savings rates that you need to find your financial freedom number. Okay. All right. Now, tax advantages are something I hear often about, and folks need more ways to have tax positive strategies built into their portfolio. And I get asked a lot, well, what's next and how do I do that? How do I achieve that? Now, if you're a business owner, then you have a lot of tax strategies available to you because the IRS code tends to help business owners do what they do, because business owners stimulate the economy, provide jobs and circulation of money, so on and so forth. So the IRS is friendly to business owners. And for those that are business professionals, there's some tax positive strategies in the IRS code as well, just not as many, but there are. So for those that say, I need more tax strategies to help me out with my tax optimization, then how about real estate? I've been hearing about that a lot. Well, there's a few areas where you can use real estate property, rental property, in order to achieve tax strategies. For example, rental property depreciation. Okay, you can use that as a deduction, and on average, rental property depreciation saves investors up to $9,000 in taxes annually. All right, that's a good number. Okay, there's other tax strategies you can or tax deductions you can make, far as operating expenses, property tax, mortgage interest. Okay, which has been limited on the residential side, as far as primary home ownership, but as far as rental property ownership, mortgage interest deduction, depreciation, repairs. All right, but it also signals that if you can write all of that off, depreciation and all of the areas that I spoke of, then that's also cueing you to say, yeah, I got to be involved in that property, unless you have a property manager, which is another thing. You got to go search for a property manager. Again, if you've been doing this for a while, great. However, if again, we're talking about 40-year-olds. Do you want to start this up in order to do this? And I'll touch at the end of the show about what net worth categories need to be exploring, say, real estate, or if you don't need to be exploring it, right? All right. So those are some tax deductions. I mentioned depreciation, which is the biggest one. 1031 exchange. It's a fancy number for using one, or a fancy term for using one property to roll over into another. For example, if you have a home rental property that you sold for $300,000 and you want to reinvest it to a $500,000 property, well, if you abide by and it's section 1031 of the code, 1031 exchange, and you can use that $300,000 to invest into the $500,000 and avoid capital gains if you abide by all of the 1031 rules. And we won't get into that today, but there's a lot of rules that you have to abide by in order to use a 1031 exchange. But that's one of the advantages as well, is that you don't have to pay capital gains on the profits of a property immediately if you use it to invest into another one. Again, if you follow all the rules in the tax code as far as 1031 exchange. Mortgage interest deduction, as I mentioned, that's a large deduction. And also too, you get to segregate costs of your expenses. If you have large repairs that you made, then you can break down some of these areas and accelerate some of the depreciation. Again, on average, that $9,000 number, as far as depreciation is concerned. And consult your accountant, and read the tax code. All of this is just for education right here. However, there are a lot of ways that you can use rental properties in order to reduce your tax exposure over time. Again, I want to wrap up with that section and say, when you're talking about mortgage interest, finding finances, operating expenses, repairs, all of that, you are a landlord, nothing passive about it. So there's a lot of advantages of being a rental property landlord. That said, there's a lot of involvement as well, and it doesn't match with your time frame and risk horizon for you 40-year-olds and plus, high income, high net worth folks, as you are trying to live your lifestyles now and prepare for retirement. There's another way that I get talked to about a lot as far as clients and prospects are concerned. They say, well, I heard that you can use your IRAs, 401ks, and you can borrow against your whole life insurance and borrow against your stock portfolio in order to invest in real estate. So using all your financial tools available to you, borrowing against them, or use them into a tax deferred account in order to purchase real estate. But what's next? Should I be doing that? All right. So, first of all, there's only a small amount of people using their accounts in order to purchase real estate. So the figure I came across is only 2% of the 35 trillion in U.S. retirement accounts is being used for real estate investing. That doesn't mean that you shouldn't. It just says that the numbers that you're hearing out here, and every time you turn a corner, it says, "Oh, I'm in real estate. Oh, I'm in real estate." That's probably not the case, right? All right. So there are a couple of ways that you can invest in real estate through, say, your retirement accounts. For example, if you have a self-directed IRA, which has a few restrictions in how you can go about buying real estate, but you can hold a lot of different assets inside a self-directed IRA. That is true. And real estate is one of them. And there's a couple of rules, like, for instance, you can't be using it for a primary residence or a secondary home. You have to be using it for investment property. So you don't want to disqualify your self-directed IRA, because if you disqualify, meaning break some of the rules that are inside of a self-directed IRA, as far as owning real estate is concerned, then you trigger a tax burden, or penalties, okay, or both. So self-directed IRAs are good tools to invest in real estate if you abide by the rules and you have, for example, a large amount of retirement. I mean, and I'll tell you what those large amounts are and why. Okay. But if you're building for retirement, particularly after 40 and you seem behind, you need to have a risk on approach, so to speak, meaning if you're 40, that means you're funding for retirement, say they're retiring at 50, 55, and 60. So you're still building wealth. And then say, let's take the latest one at 60, and you're having to distribute your wealth over a 30-year retirement period. So it doesn't mean that you need to take the gas off as far as, risk is concerned. All right. That said, you can't have a whole bunch of risk to where your principal investments are at risk and taking downturns of every 5 or 8 or 10 years. And then you have to catch back up, when most of Gen X, no matter what your retirement number is, 3 million, 5 million, 10 million. Okay. Most folks just feel a lack of preparedness for their retirement. So yes, you need to have some risk. You need to have risk in your investment portfolio, but not too much to where you are harming your overall wealth goal, yourself, right? So there's a lot to be thoughtful there when you're talking about either not achieving the investment returns that you need, or taking too much risk to where you have exposure to extreme downside in some assets across your portfolio. All right. So self-directed IRAs is a way to go to own rental properties. You can use it because a lot of folks either don't know or they want to use their IRAs to buy real estate, don't know how, or if they are already doing it, then that's great and it's working out for them. But you want to just look at your own situation right now and see if that's a best option for you. And again, I'll touch on some particularly for 40-year-olds, should you consider it or not? All right. Whole life insurance. You hear a lot about borrowing, being your own bank. All right. Having a tax-free loan against your whole life insurance in order to fund either a business or real estate or something in order to outpace the interest that you're being charged. And it's low, it's very much lower than, say, you would go cost of capital at a bank. And also it's tax free if you're talking about borrowing against your whole life insurance. Although when you borrow, you have to pay it back or have it deducted out of your death benefit, you know? And then also too, you're 40 years old. If you don't have whole life already, it's going to take you, first of all, you're buying whole life insurance at 40. So you're closer to death. So it means your premiums are going to be high and you have to fund a whole life policy for a long time to get the benefit of having a bank. All right. So if you're 40 plus and don't have whole life yet, all right, which is permanent insurance, cash value life insurance, all these are synonymous with each other. Then starting at 40 is very hard when your other accounts, brokerage, IRAs, 401ks, all of these are underfunded or need more funding. All right. And if you do have a cash value whole life policy, then you would have had to be building it up for 10, 15, 20 years in order to have enough money, in order to borrow against it, to not only have a death benefit available, but also enough to take a $50, $100, $150, $200,000 loan. Okay. You have to have that in there. Okay. So it's not as easy as it sounds. You either have it and you're wondering and you're trying to figure out what's next and you have the bandwidth in order to borrow against that, your whole life policy, and have when I say bandwidth, capacity, time, resources in your whole life. Okay. All of that in order to purchase the properties. All right. Now, if you have the bandwidth and capacity and it fits, okay, well, that's just another resource that you can borrow against in order to continue what you're doing, perhaps. Okay. Brokerage accounts, I hear this all the time too. Is like, I want to borrow against my stock portfolio in order to, or leverage is the word, right? I want to leverage my stock portfolio by borrowing against my stock portfolio to get money at a lower rate than I would have to get cost of capital at a bank. And then again, fund something in order to outpace the leverage. Okay. So you're using your stock portfolio to, as collateral to get access to money that you can then use for a rental property or two. And again, yes, there's some positive aspects of this strategy along with the others as far as access to capital that you already have in your retirement accounts, whole life insurance, and your brokerage. That's all fine and dandy. If you have, and when we talk about the what's next, okay, we're always analyzing with, do you have that capacity in order to, and that time and that expertise and the willingness to want to, okay, in order to purchase more real estate. Not saying that after 40 that you can't or you shouldn't, okay, because some folks with higher net worths and all that capacity that I'm speaking with, it could be a good investment. We've got to look at it, okay? But it's to each individual, each household, and I do want to, the purpose of this episode is to put information out there to get folks to thinking, to say that it's just not that easy jumping into real estate. And when you ask what's next all the time, it may not be real estate. It may be something else, and it may just be keeping doing what you're doing. All right. So there's some other ways that you can get into real estate, not just direct real estate. Okay. You can, there's more quote unquote passive investments that you can get into. Remember I said the passive, when you're owning property directly, it's not passive. You're very active. Well, with other ways to get involved with real estate, there is indeed passive involvement, which is crowdfunding, real estate syndicates, REITs, which are real estate investment trusts in the equity markets, private placements. So there are passive activity ways to get involved in real estate other than direct ownership. However, those have their pitfalls and advantages as well. One, sometimes you have to be an accredited investor in order to invest into private placements or real estate syndicates. Not all real estate syndicates are accredited investor. And what is an accredited investor, by the way? You've heard this term. Well, it's having $1 million of net worth and at least $200,000 in earnings the last 2 years. Okay. Now, if you're an accredited investor, when it's basically saying by the SEC is saying, well, if you have $1 million of net worth and the income, then you could potentially afford some of the illiquidity risks that come along with directly investing in real estate. That's basically what it's saying. And there's a lot of back and forth on whether you need to be a credit investor in order to invest in some of these areas. But that's the gist of the rule. The gist of it is trying to protect folks from, using a majority of their net worth to place into investments that may not be a good fit for them and on target for retirement. So it's somewhat of a protection area rule. Again, we can use another show about talking about a credit investment. But real estate is syndications and crowdfunding platforms. You've heard about Fundrise or Realty Mogul or a whole bunch of other crowdfunding platforms. What's the difference between crowdfunding and real estate syndicates? Well, real estate syndications are pretty much you're a partner. You own equity in a particular project that is being managed by a sponsor. So someone that may be investing in commercial real estate, residential real estate, maybe a neighborhood, maybe a commercial building with rents coming in. Then these are pooling mechanisms, real estate syndicates and crowdfunding platforms to pool money from individuals in order to invest in, and particularly with real estate syndicates, a project. So you have equity into perhaps a residential neighborhood build or a commercial building with rents, or so you own equity in those projects, and then you are getting kicked off dividends off of that, off of those when the project is finished. You can either receive a stream of dividend payments, and then later you can get access to your principal as well. With the real estate syndicate, you have to give that time. This is what we call illiquidity, meaning you invest your money, all right, but the project has to be finished. That takes time, and then there's time to kick off those dividends, and perhaps there's a waiting period to where you can get your principal back also. All right. So although you don't have the active investment of direct ownership of real estate, all right, you do have other trade-offs for being involved in a real estate syndication, and whether it's being promoted as a public real estate syndication or a non-public. It determines on whether you need to be an accredited investor. And if it's non-public, then you don't have to be an accredited investor. Crowdfunding platforms, you can be a partner or a owner in the equity or the loan itself. So equity or debt. And the biggest benefit of a crowdfunding platform like Fundrise is that the small minimums that you could invest in order to get access to the real estate sector, say like $500, $1,000, $5,000, much less than the tens of thousands that you need most of the time for direct investment and also to make a real estate syndicate beneficial. Also, REITs, you can buy real estate investment trusts as ETFs on the stock market. That said, we hear a lot about interest rates. So interest rates, they fluctuate and affect the total return of a REIT ETF, and also too the dividends that come off of that REIT are treated as ordinary income. So lots of trade-offs there when you're talking about how to get alternative ways to access rather than direct investment. All right. Here's some of the pitfalls I want you to know. Now, there was a movie, I forgot what it was. It's with Michael Keaton, I think it was, and he was invested into this house, and he was trying to repair it and build it all up, and it was a hot mess. If y'all know that one, comment in the comments and let me know. I usually know my movie quotes really good, but watch that movie, by the way, and it'll give you a sense of should you be placing a lot of money into a home, and also listen, not a primary residence, but a property in order to flip it or for an investment is concerned, being a landlord, right? And also too, ask stories of folks that have owned property or getting into property. You get both sides of the story. Yes, wealth is accumulated in real estate, sure. But as I kicked off the show, when I give you some more statistics, that not everyone that has wealth has real estate. I'll repeat one of those right here. Only for those with $3 to $5 million in net worth, about 15% of them own rental properties. So that means 85% of folks that have 3 to 5 million in net worth don't own real estate. All right. So what are some of the risks and pitfalls? Okay. Here's a statistic for you. 42% of landlords report unexpected maintenance costs as their biggest financial stressor when talking about owning rental properties. Okay. So unexpected maintenance costs. That means you have to have cash on hand in order to be a landlord. And we already talk about folks that don't have enough don't feel confident in their retirement in order to max fund all of those areas, as far as brokerage, IRAs, 401ks, all of this nature, and not even having fully funded emergency funds 6, 9, 12 months, depending on what your cash flow as far as your business executive position or your business ownership. All right. So then you have to have another stash, okay, for the rental properties that you own. So now we're talking about time commitment, market risk, tenant issues. Oh my gosh. And cash flow risk, as we just talked about. So do you want to, at the end of the day, all right, do you want to invest this much time? Okay. Do you want to have the market risk? Do you want to have the tenant issues? These are big issues that you have to deal with in order to have these rental real estates. All right, let's close out the show. This is longer than what I usually do for a show, but I want you to have enough information for you in order to, really think about, is real estate for you if you're 40 and above, right? And another statistic that came to mind is real estate investing after 40 requires smarter strategies, as 74% of this group prioritizes retirement planning. And yes, so when you're talking about getting access to real estate after 40, you're prioritizing retirement. So if you need money to maximize your aspirational financial freedom number, all right, well, are you wanting to take on additional time risks, illiquidity risks, cash flow risks, and many others in order to start a real estate portfolio to help grow your wealth? Maybe not. All right. So yes, it's an option, but no, it's not the only way. And depending on where you are in your net worth journey, all right, and direct ownership of real estate could be for you. The most popular that I've seen is real estate syndicates. I think those are, far as a balance of risk trade-offs and good fit, that's one way to, if you're talking about all the options, that's a decent way to get exposure to the real estate market, get some dividend income or cash flow income, and also be a truly passive investor in real estate. That's not a recommendation, but from what I've seen out there, and even the folks that own real estate, they're like, you know what? I've had it long enough. I want to sell. All right. You have owners of real estate that have had enough of being a landlord and want to sell. So after 40 may or may not be, depending on your capacity and your risk time horizon and a lot, to consider real estate. And I'll leave you with this, that in general, what I've seen in my almost 20 years of experience is that, if you're on your wealth building journey from 1 to 3 million, direct real estate may not be the best fit. And I'm using generalizations and averages here. If you have about 3 to 5 million, okay, direct real estate, you have some assets to leverage, say like whole life, your stock portfolio, your and other your retirement accounts, okay. And, or if you just have, even a brokerage account to pull money out of, okay, 3 to 5, perhaps. All right. But that's still it. You have to weigh against what your goal is. What are you going to get out of it? Okay. A long term, and 3 to 5 million, there's perhaps on what your financial freedom wish number is. You may not have that much wiggle room. Okay. Depending. But you're getting a little bit more liquidity here to where you can have some of the risk, particularly the cash flow risk. All right. If you have $5 million plus, okay, well, now you have a little bit more liquidity, and you probably have the assets to borrow against to start getting into some larger projects and increasing that return on time and return on investments. And in a $10 million plus, all right, you have a lot of wiggle room. All right. So there's tiers. 1 to 3, just keep on building in other ways, perhaps. 3 to 5, yes, you have a little bit more wiggle room. 5 million plus, all right, that's when we're starting to get a little jiggy with it, and you have a little bit more room to handle the cash flow liquidity. And 10 million plus, you're getting into those larger projects that really have your return on time and return on investment. And one last thing, again, I want to say this: even folks with real estate properties, they tend to get tired of it, and they want to sell. All right. Well, that's what I got for you, real estate. Everybody asked what's next. This was a show that ran a little long, but there's a lot of information out there that's not very good. So we wanted to run down some information that's pretty good. When you're concentrating on using your high income and high net worth in order to fund your lifestyle now and build retirement later, and you're after 40, you got a lot to think about. All right. That's what I got for you. If you like what you heard, seen, and feel on the show, please like, subscribe, and share with your friends and colleagues and family. And until next time, we'll chop soon. Cheers.